Good morning, good afternoon, good evening to our global attendees, and welcome to the Acuity Knowledge Partners webinar, Unlocking Opportunities in the Commercial Mortgage Market. A big thank you to our esteemed panel with CRE veterans from KeyBank, PNC, and Raleigh Credit Union, and of course, one of my colleagues, Rajeev Hota, who also heads up our commercial real estate platform. My name is Nishant Khatri, and I head up strategic banking relationships based out of our New York office. I've been with the firm about just over 19 years, and I previously worked in our London office and our India office as well. The agenda for today, sorry, the previous slide, please. The agenda for today, we'll have a quick round of introductions from our panel, an Acuity introduction as well. And then, we absolutely, have a very interesting agenda around 4 or 5 themes that we want to cover. And then, we'll have Q&A towards the end. At any point in time, if the participants, have a question, just, feel free to type that out in the chat. We will take those up towards the end, but, at any point in time you feel you want to raise a question, just, feel free to, put that in the chat as well. This is a representative profile of the attendees that we have from Asia, EMEA, and North America. Certainly, representation from the 3 panelist organizations, but also numerous American regional, global banks that we have today. Let's quickly move to the Acuity introduction, and from there on, we'll move to introductions with our panel. So for the folks who don't know us, we are the #1 provider of research and analytics to the global financial services industry. We consider ourselves #1 because of the number of clients we have, the number of FTEs or the resources that support these clients, and the kind of work that we do with a specialist focus on financial services. We support investment banks, advisory firms, equally commercial banks and retail banks, and on the buy side, we support both public and private, traditional as well as alternative firms, and then the top 5 consulting firms are also our clients. We've also augmented our differentiated research services with proprietary beat technology and peripheral services such as data analytics, data science, compliance, and custom technology development. And we deliver this proposition nearly 24/7 out of our offices from India, China, Costa Rica, and Sri Lanka, and most recently, Germany as well. We are a transformation partner for numerous clients, and we essentially help them accelerate and enable their transformation agenda. We're working closely with business heads, like the folks that we have on the panel today, equally the C-level suite from CFOs to COOs, who are really focused on centralized transformation. As a partner, we are an end-to-end provider of research and analytics services across banking. I covered some of this, and more specifically around the front office, the first and the second line of defense, and equally we do a lot of work within data and middle office as well. And all of that is augmented, by our data and technology services. With a specific focus on commercial real estate, So with a specific focus on commercial real estate, we do a lot of work across origination, portfolio monitoring, consulting work, and we have specialists. There is no other firm that's doing this today, so that makes us, further of a specialist in terms of credentials, in this space. That completes our Acuity overview. And with that, I would love to introduce, our panelists, kicking off with Doug Silva from Raleigh Credit Union.
Yeah, just kind of give a little intro about myself. Yes, I'm Douglas Silva. I currently serve as the Vice President of Credit here at Raleigh Credit Union. We're a $4.5 billion credit union headquartered down here in South Texas. I'm thrilled to be part of the panel. Over the past 15 years, I've dedicated myself to the field of commercial lending. I spent a decade as a commercial lender, an additional 5 years, focusing specifically on credit and credit risk management. And then it's great to hear everybody else's fun facts, and I'm kind of excited about mine. A fun fact about me is that I share a birthday with Google. So like I mentioned, you go on google.com and they have the balloons and the presents and everything. So I feel like that's a little bit for me, but that's every September 27th. So I get to celebrate alongside them, and I'm just really excited to engage with not only the panelists, but everyone else attending.
Thanks for that, Doug. Ken, over to you.
Yeah, Ken Schroeder from KeyBank. I've been with Key for over 26 years. I've had various roles through technology, servicing, and now in our off-balance sheet commercial mortgage group. I have oversight responsibilities for over 200 Acuity analysts offshore, and responsible for our operations within our commercial mortgage group, overseeing technology, business processes, and efficiencies. Fun
Thank
fact
you.
about that is I spent 15 years building a car, a red convertible that I'm fairly proud of, have my website for. So I'm a car guy, love everything about it. So a fun fact.
Oh, that's great to hear. Thank you. Paul?
Nishant, hey, thank you for having me. This is Paul Jamiolkowski at PNC Bank. I head the real estate banking division for PNC. We are, for those that don't know us, we are the fifth largest bank in the United States. We're about the same size in our real estate portfolio. We have roughly a $60+ billion real estate portfolio that really goes from coast to coast. So we lend to both private and public companies. We do your traditional lending. So we do construction loans, term loans, lines of credit, those sorts of things. Started my career on the West Coast with PNC, did some work with our public companies, the REITs, and then again, most recently have been heading up all of our sales side. So excited to be here. Thank you for having me. Fun fact about me, ironically, I am born and raised Chicago. So I have been both a Cub fan, Bear fan, as well as a Steeler fan growing up. I grew up in the 70s when the Bears weren't all that fun, all that good. So I grew up with a Steelers fan. So it's sort of nice to be splitting my love for both Chicago and Pittsburgh.
That's great to hear. And I'm sure one of those teams is having a good season.
The Steelers are, yes, they just had a great win this Sunday.
That's excellent. Thank you so much. Rajeev?
Thank you, Nishant. Hello, everyone. I'm Rajeev Hota. Over 20 years of experience into commercial real estate industry. I started my journey with a consulting firm where I was for 2 years doing origination underwriting. And post that, I was with BlackRock, again doing underwriting for the commercial real estate there for 8 years. And then for the past 12 years, almost, I'm with Acuity, currently spearheading the commercial real estate lending practices. So glad to be introduced here today. Thank you. And fun fact about me is I love road trips. While my wife keep exploring about hikings in mountains, I keep exploring about new foods where I can, take the opportunity to eat. So I love eating actually. So that's a fun fact about me.
Thanks for that, Rajeev. Well, I'll share a fun fact about myself, because I went earlier on the introduction. So I hate to shop because I'm very selective when it comes to buying anything. So typically when I like something, I buy 3 or maybe 4 pairs of that. So I have 4 pairs of the same shoes, many very similar shirts, many very similar suits. So my wife and my family feel that that's a bit crazy. A lot of people say that that's weird. I think it's genius because it saves time. But yeah, that's a bit of a fun or weird fact about myself. But hey, look, thank you again for making time to be on this panel and speaking with us today. Like I mentioned earlier, there are about 4 or 5 themes that we want to cover in the next sort of 50 minutes or so. So let's kick off, right? Interest rates is something that is top of mind for everybody, and we've seen that a consistent period of high interest rates has slowed down origination volumes in 2023, 2024, maybe even 2022. Now, even though interest rates are coming down, and that has been a very recent event and possibly a trend as well, how do you foresee market demand and client profitability evolving from here on? Let's start with Paul on that.
Yeah, thanks, Nishant. Yeah, so I'd probably answer this by sort of maybe just backing up a second. I mean, we in the large banks market, we really had tremendous activity in 2022. So I think most of the large banks that competed in commercial real estate had pretty active pipelines, pretty active deal volumes in 22. It did tail off in 23 as rates started to increase and things were sort of, maybe people didn't feel as good about the economy. And we went through a period in 23, which really carried into 24 being slower. I would say that by the middle of this year, kind of call it July, even before there was a rate cut at all, we started seeing a pickup of activity across our client base. And that would be in the project space as well as sort of in the entity finance, whether that be lines of credit or funds, et cetera. So we started seeing activity pick up sort of going into the anticipation of a rate cut, which is, I would say, continued through. So I think people are really thinking that maybe if they, on the project side, maybe if they start something right now, they might sort of hit a 26 window. Takes probably 18 months, 2 years to sort of get something done. So people feel like they'll be on unstable footing if they sort of get something started maybe now and get in front of other people. So we're starting to see people who have capital trying to either get capital or trying to employ capital sort of incrementally right now. I wouldn't say that it's a rush to the door getting done, but we're seeing sort of a pickup because of interest rates. So I do think that in general the competition for deals with existing clients is most competitive. We most larger banks again are being mindful of how they're really growing their real estate portfolios, but with existing clients, people are really getting competitive, trying to serve them the best. So that's really sort of playing out right now as we speak, and as we go into the fourth quarter. I'll leave it there to Shan.
Thanks for that, Paul. Ken, over to you for your inputs there.
Yeah, I would echo those same comments. I would extend the conversation a little bit that we really see the volatility of rates stabilizing in 2025. Treasuries will likely stay higher, but spreads, will adjust and stabilize. And even though rates have fluctuated some over, recently, Freddie Mac is going to hit their cap for this year, not necessarily on Fannie's side, but a lot of strong lending with Freddie Mac. Key is moving to the offensive now, just like other banks are. Demand will start and has started, but is really starting more so on our institutional space. And then we do think the second half of 2025 will be stronger for our project loans. Affordable housing is a strong area of focus and growth for us. Our FHA pipeline is stronger than it ever has been due to post-COVID stabilization, and multifamily will continue to remain strong, throughout next year. So we're continuing to drive business through existing clients, just like PNC is and a lot of the other banks are, but competition can, probably will and continue to remain challenging for that. But we're hoping to grow business with our existing clients and add new clients that fit our strategy. And we're hoping that revenue growth will really target around the high single digits for next year. So that's kind of our outlook for next year.
Thanks for that, Ken. Doug, I'm sure you have a unique perspective here, given sort of credit union markets that you operate in. How does that align with what we've heard from Paul and Ken from a big bank perspective?
Very similar. Kind of echoing what Paul said. Commercial real estate can either be seen as dead or maybe even temporarily oversupplied. I like to hedge on the positive side. I expect a slow recovery from that work from home gap that I experienced, and something kind of in line with both what Ken and Paul said. The Fed decision to continue to lower rates, the most recent, not too long ago on September 18th, rate the 0.5 point. So now we're sitting at 7.75 Wall Street Journal Prime. There's a lot. It's stirring up a bit of optimism, and I think that's the best thing. And in line with demand, of course, lower interest rates usually make borrowing cheaper, more appealing. So we're likely to see a little bit of a boost, just like Paul mentioned, kind of rolling 25, 26 across the various real estate sectors, especially places like multifamily housing, industrial spaces that already kind of have like a strong market fundamentals. We may not see a huge shift, but it's potential to be a great time for developers and investors to kind of push forward with projects that may have been a little too costly just a few months ago. I mean, we're talking about just maybe 90 days ago. And then the question about profitability, I mean, the rate cut's good news for anyone with the variable rate loans that can kind of ride that fall forward, and then just means really better cash flow. So it can make a big difference in the financial cushion, that little bit of excess cash flow availability on an annual basis, just in case things do get a little bit more bumpy. But I do think that, the shift will ease up on those. I saw a lot of like extend and pretend, kind of kick the can down the road for the maturities that are coming through. The kind of like that strategy that delayed kind of recognizing the losses. But with less pressure on the borrowers, thanks to the lower rates, we should see like a healthier, more straightforward environment for CRE. So I'm kind of excited about that. Very positive outlook.
Got it. Thank you for that. That's very promising. Rajeev, would you like to weigh in?
Sure, I'll echo what others said. Going by the turbulent time after interest rate hike, we see market is really going down. Regulators are stringent on the asset quality and loan quality. However, post the July rate cut, if you see by figures, the non-agency CMBS issuance in October was 14.5 billion, which is highest since November 2021. And the single borrower CMBS issuance was 60.3 billion year to date, which is 3 times of 2023 volume itself. That itself speaks about market sentiment and trust on this industry. On the top of it, more than 500 billion amount of loans set to mature in the next 12 months. So a great opportunity for all the lenders to tap the market. And with interest rate going down and hoping for a next interest rate cut, I believe this industry will see more and more focus towards new originations in the market.
Great. Thank you for that, Rajeev. And it was great to hear that everyone thinks it's going to be positive and uptrending. So my next question, and this is from speaking with lenders and leaders in the commercial real estate market over the last 12 months, and regarding their view on their portfolios, and obviously things are very different, right? 12 months ago, and nearly everybody was working it out with their borrowers. Certainly, a part of the portfolio that wasn't doing very well. Now, how has that evolved in your portfolio? And do you feel that there are any trends worth capitalizing on, maybe interest rates or what have you? Let's kick off with Doug on that one.
Sure, yes, sir. Yeah, thanks for the question. Looking back at kind of beginning of the year, early 2024, a lot of us in the commercial real estate space were pretty much kind of in survival mode, like you mentioned, the kind of working it out with the borrowers up until that point, right? Trying to get everyone through kind of like the more choppy waters, and then you fast forward till now. We've had 2 rate cuts, 75 basis points, and things have taken a turn for the better, it seems like, and that's where I'm pretty optimistic. Especially with the Fed lowering rates and kind of having the attitude and perception to do that here for the next 18 to 24 months. Your question about what changed on portfolio, it seems like we kind of went from playing defense to going on the offensive end. With the new kind of lower interest rates, there's this the fresh wave of optimism, which I echo, of course. And in the industry, we're not just trying to keep our heads above water anymore. Instead, we're kind of looking for new opportunities, kind of rethinking strategies to match the current path of the market. And with that, the trends kind of worth jumping on. There's a couple that look promising. First, multifamily properties. Like multifamily properties are still hot, especially, our location, like I mentioned, is South Texas. And so people are always needing places to live. The more jobs and the expansion development kind of popping up in certain areas, it just makes sense to kind of boost our stakes there. Industrial scene, I think, also has a lot of promise, a lot of positivity there for the outlook. Warehouses, logistics centers, especially around the bigger cities. I think those are gold mines right now, all thanks to kind of how we shop online, those warehouses, and we're thinking of expanding our footprint in that sector, kind of the other portions of Texas for us specifically, kind of snapping up some of those new properties. So yeah, the game has changed definitely a lot since the beginning of the year, since early 2024. We've gone to actively seeking ways to grow and tap into those booming areas. It's definitely an exciting time, and we're all geared up to make the most of the opportunities, especially with our relationship with Acuity yourself. I feel like our financial institution specifically is really primed for a promising position. So pretty excited about that.
Good. Thanks for that, Doug. Paul, your perspective there?
Yeah, so my 2 cents on it would be that I think that it's sort of still the same. I think that in the large bank segment, I think most of us are really trying to work it out with our customers, with our borrowers. I would say that most of the stress in anyone's portfolio is really concentrated in the office segment, and I think all parties are really trying to do what's best in and around the assets. So that has a variety of outcomes to it, but I think that where there's good resolutions that can be possible, I think Rajeev was talking about the SASB market earlier. There's been lots of deals that have found their way into the capital markets. Whether that be CMBS loans or SASBs or et cetera. So I think that there have been positive stories coming, out of the office portfolio, but there's certainly, other stressful situations also. But, I don't think things have changed dramatically from last year to this year in terms of really how the large banks are really trying to work with their customers. I do think that there are resolutions coming. I think that, again, we would like them to probably be, faster than they actually are. I think that things are taking a little bit longer to kind of get there. And that's really in and around that sector, on the office sector, there's really not a lot of liquidity in terms of refinancing. So it's just a little bit harder to really find, a good resolution on those assets. But looking at the rest of the portfolio, I would say that there's really not that much of a change for us. I think that we, our strategy is really to be, really housing first, multifamily first. Kind of a lot of our loans that we have in our portfolio are in and around multifamily or some form of that. There was some stress that came in terms of the operating expenses, et cetera, in around kind of any multifamily project as taxes and insurance and stuff went up pretty dramatically year over year. But I would say that, it's sort of normal course of business in terms of how we're dealing with any of those loans. I think that there's tons of equity in those deals, lots of value. And, it's really, most of those loans are really not in much stress whatsoever compared to the other sectors. So if I were to really, really focus in on anything, we'd really run the office side of it, which we're, finding our way through. And I do think that probably takes its way into 25, 26 before really all banks are kind of through with it, in my opinion. But it's a little bit longer just given how slow it is to sort of get to some resolutions.
Yeah, I'll just add a couple things to what Paul says. There it is a lot of the same. We have this dual mandate, regardless of what season that we're in. We need to manage the quality of our existing book, and we need to originate new volume to replace some of our debt that is rolling off. We need to be able to continue to replenish that, but we need to be able to do that strategically and do that with clients that meet our profile. So we're encouraged. We want to be able to grow our balance sheet portfolio. And like always, our off-balance sheet book, similar to PNC, we have pretty much unlimited growth potential there. So we always want to focus on growth for lending in our agency business, our CMBS business, our institutional business, wherever we can that meets our investors' needs. So we can provide debt from any institution, from any funding source to be able to meet the needs of our clients. So we want to make sure and grow our client base to be able to serve their needs going forward.
Building on the environment, the particular aspect of the portfolio that hasn't been necessarily doing well. What sort of recent changes have you implemented to enhance effective credit risk management at your bank or credit union? Have there been any specific ones that have politically proved successful for commercial real estate? Ken?
Yeah, I wish we could say that we've implemented, new AI technology that does everything for you, that finds all the hidden cracks that are in the foundation. But really, it's doing what we do, just doing it better. We're less task focused and more strategic in our oversight. We really haven't made any changes to staffing or credit quality. We've just enhanced and sharpened our oversight of our existing book. And we've really focused on reinforcing with all levels of staff the understanding and the expectations of credit quality, what to look for, and being able to reinforce our understanding of our book. Now, there are some things, that we've done and tried to take it to the extra mile. We've enhanced our stress testing process to be able to see how rates impact cash flows. We focus more on climate and insurance oversight because that's impacting our existing and new business. And insurance is kind of maybe another question or a topic all into itself. And the regulators are always asking for more information, and it's a challenge to be able to give them what they need in a timely manner. So we've really been focusing on transparency, our data, and being able to justify our risk ratings and support what the regulators are asking for. So that's kind of been our focus of how we're managing our risk management process.
Thanks for that. Doug, would you like to weigh in?
Sure, definitely. I'm maybe a little biased, but risk mitigation and credit risk management is like really definitely at the heart of commercial real estate lending. And we've made a lot of strides here in the last 12 months for our financial institution specifically. Over the past year, we just really kind of stepped up our game and had a lot of concentration in the growth aspect, and with that means risk mitigation, right? Some of the changes that we've implemented, really kind of going digital on some aspects. We've tapped into more market research reports. I've really kind of branched out to try and get ahead of any sort of like potential turmoil. It kind of lets us help get a real-time feel for market trends and also our borrower health. That way we can react much faster if things start to get a little bit shaky. And then, like I mentioned, the relationship, bringing into Acuity, bringing Acuity into the financial institution has been a large part of our successes as well. Although the relationship is young, having that kind of holistic approach to underwriting with different perspectives has been a great asset to have. For specific strategies that are working well, kind of echoing Ken, one big win has been kind of just integrating more dynamic stress testing into our routine evaluation. So we're not just talking about the occasional kind of like checkup or loan review. We're doing deep dives regularly, especially where we have concentrations or exposure. So that approach lets us see how different scenarios would impact our portfolio. Everything from potential sudden economic downturn to changes to potential, like we had that work from home shift. We have return to office, RTO for CRO that are affecting a lot of the pieces. So enhancing our due diligence process on the front end. We've gotten a lot more thorough when assessing new borrowers and projects that include stress-related entities or other sources of cash flow that can help structuring of the loans and kind of like also our real estate documents. So we're looking at our loan agreements very closely, kind of just ensuring that we're in a good position. And the credit risk management and the risk management in general, it's not about necessarily just dodging the bullets. They help us identify real gems, like real potential borrowers that might look too risky on paper, but have the potential to thrive with the right backing and the right loan structure. It's about balancing that caution with opportunity. And so far, that balanced approach has been paying off for us in the past 12, 18 months. So that's why the outlook looks so positive.
Got it. Thank you for that, and thanks for the Acuity call out also. Paul?
Yeah, Nishan, I'm going to give you a shout out as well. But just to start off with, I would say that I think that at PNC, credit risk management is really kind of inherent. It's really baked into kind of what we do every day. We actually really expect our sales folks as well as our credit folks to work as a team in terms of identifying any kind of risk. So it's not anyone's job; it's everyone's job to really identify kind of any kind of risk in the portfolio. So that really starts from the beginning to the end in terms of how we manage relationships, how we manage loans. But I'd say a couple of things that we've done. I heard what Ken said. We're doing a lot of the same kinds of things in terms of sort of being more robust in terms of our analysis in the portfolio. But a couple of things that we do probably more in depth and probably later on is really more targeted reviews in and around our portfolio. So we are using the opportunity for these targeted reviews to really look at our portfolios. Again, I mentioned office, mentioned multifamily. We were having those on a not quarterly basis, but a more frequent basis, looking at the overall portfolio, really looking for anything that might be of any risk inside the portfolio. And we are also making sure that we're looking at all of our deals that really are sort of graduating in terms of stress or risk on a more frequent basis and on an earlier basis. So in the past, we may have done some of these things maybe on a one-off basis. We're trying to be more consistent kind of how we look at overall transactions, bringing them through very centralized forums so that we have commonality in terms of how we're sort of approaching decisions, whether it be an office deal and on the West Coast or a multifamily deal on the Southeast, whatever it might be. We're trying to really approach things kind of consistently. So I would say that sort of using what we do today in a more efficient manner is really how we are kind of really changing and trying to approach it. And that's where Acuity comes in. There's a lot more work that's being done in and around these reviews. So you guys are really helping us in terms of getting the information, getting it into our systems, being able to really get it in a more efficient manner so that our folks can really do the work of analyzing it. So that's really how we're teaming up with you guys in terms of the work. It's been really fantastic in terms of how you've leveraged us up in terms of being able to do the work that we do. So and I would say, I think in terms of the question, the one specific thing other than you guys, which I would put up there is on the top, is really just time. in terms of us really being able to, mitigate any kind of risk in the portfolio, we like to get ahead of things. So, where maybe in the past people would have been looking at these things closer to maturity or closer to some specific event, we're trying to get 90 days, 6 months in advance of that, so that we have the time to be able to work with the customer and figure out what's really the best strategy. So, really trying to use time to our advantage versus our disadvantage in mitigating any kind of risk in the portfolio.
Got it. Thanks for the call out again, Paul. Thank you so much. And
Of course.
Rajeev, you have a lot of experience in this area. What are your thoughts on sort of how banks are doing this today, and credit unions, obviously?
I'll echo all the panelists here. I would say that this current crisis which we just passed, actually it helped a lot from the subprime crisis learning to avoid a bigger loss. I would say that we can say that regulators are more stringent. They are tagging so many loans as MRAs, matters requiring attentions, and most of our clients taking our help to create a workout strategy around those MRA loans, so that those early warning signals or Acuity helps to create the portfolio level analytics or dashboards really helps them to transform their risk assessment strategy and how they can navigate further to avoid such MR accounts. So that's what we have seen. And moreover, in the underwriting strategy, we have seen that banks started benchmarking their underwriting rate to their risk rating rate, which is the most stress scenario, so that they tackle to all the stress probability while underwriting a loan. So that is another thing which we started seeing in the market. And moreover, while underwriting any kind of properties which is not yet cash flowing, especially in the balance sheet lending, be it bridge or bridge to interim loans, we have seen that there are a lot of focus towards the leaser probability and the cash flowing ability, then only stabilized scenario at end. So there is a continuous monitoring and focus towards the risk appetite of that property type and the cash flowing probability.
Got it. Thanks for that, Rajeev. That's much appreciated. And let's talk a little bit about technology, right? Every conversation that we're in today, there's talk of Gen AI, GPT, and tasks that can be automated. And with the world moving really fast towards AI, and commercial real estate historically or traditionally has been a slow adopter of technology, right? Now, upgrading to new technologies can always be a challenge, or challenging from an implementation perspective. Has your business implemented any new technologies or platforms, and sort of what has been your playbook, as leaders in this space, to integrate these technologies in your business? We'll start with Paul there.
Yeah, thanks, Nishant. Yeah, so obviously, incorporating new technologies is sort of core to sort of evolving as a business. So we've been constantly doing that, for many years, and it is a challenge. I will say that bringing something new system in, we want to make sure we have the safety and security in and around any system that we sort of engage with or put any of our customer information through. So it's definitely a key focus for us. I would say that in terms of AI, we have folks really sort of trying to use that first and foremost to sort of really get rid of any kind of manual labor, manual entry, those sorts of things that an AI bot can do better than a human being. So really using it more so to get down to that sort of lower level type work and get the folks that were doing that into more analytical type work that they should be doing. So that's really kind of where I'd say we're probably doing it the most. The way that we're trying to maybe leverage that better today than we did in the past is really by elevating really our underwriting groups and our data analytics folks in terms of the conversation. There's a lot more cross collaboration that goes on in conversations that go on amongst us as a leadership team, which include folks from all those different disciplines. So I do think that when we're making decisions how we're using it, we're looking at it from the beginning to the end, users, customers, what the data we're getting out of it. But really, it's that cross collaboration team effort in terms of really looking at systems, looking at solutions that really is probably critical for us in terms of being able to implement. But in terms of like being able to bring it through, it's still going to be a slower process for us because we want to make sure it's all going to be exactly what we need to be using. But technology is going to be our way forward.
Got it. Got it. Thank you for that. Ken?
Yeah, we always try to be kind of a fast follower here. I mean, we've been using targeted bots to automate repetitive processes for many years. We've been doing AI and machine learning for many years that extract data from operating statements and rent rolls and classifies the data based on Fannie Mae or Freddie Mac standards. So that's been in our wheelhouse for quite some time, and there's some vendors that do that really well that we like. However, it does take time to be able to evolve the technology. We do like to partner with experts that specialize in some of this. We're working with Moody's to explore, end-to-end life cycle support tools to be able to leverage their data and put AI and Gen AI on top of portfolio data. They have some really neat tools that are out there. I would say one, hopefully it's an obvious requirement that the broader that you get with AI and with, trying to do some analysis work is you need to have your data in a way that you can rely on that data. And I think that's where some of the smaller firms might have a little bit of an advantage. Once you start to consolidate data from all across Key, that can be a challenge as far as the consistency and the quality of that. So there are pockets that are better than others, and having your data is in a reliable format with the confidence in your data quality is a requirement. And I think that's where some of us, we're going to be spending our time getting our data in a good shape to be able to really leverage the true benefits of Gen AI.
Thank you for that. Doug? Your
Yeah.
perspective there?
Yes, sir. So, banks and specifically CRE industry hasn't always been first in line when it comes to embracing new tech. But thankfully, our leadership team, our Chief Lending Officer, Dan Dibble, CEO, Dana Sisk, everyone's really about embracing and integrating new technology. It's all about taking those baby steps though. And, I talk about it with our SVP, Maria Karsha, and we don't want to overhaul everything overnight. We want to stay by identifying parts and operations that could really benefit from a tech boost. Like automating the more mundane tasks, just kind of free up our team for more complex issues and kind of utilize them for the asset that they are. And you want to focus on the partnership, the collaboration. We're not talking about kind of just like an IT upgrade. It's more of a whole like business shift. And we work closely with our tech providers, transition with Fiserv, Baker Hill, yourselves, Acuity as well. And that way we can customize solutions that fit our unique needs. And that's the thing about kind of being a credit union. Ken mentioned it. Our size is a lot smaller asset size, so it's a lot easier to kind of steer the ship whenever you do decide to make certain decisions. And so we try and use that to our benefit. And that's where training is key. Implementing the new tech is one thing, but making sure our people know how to use it effectively is another thing. We invested a lot of training. Upskilling our staff, not just one-off sessions, but continuous learning. So that way everyone's confident and competent with the new tools and we're utilizing them and maximizing their ability. And then from there, just kind of being patient, but persistent. I think any sort of tech integration, whether it be AI, whether it be having a relationship with like a QSO, tech integration is more of a marathon than it is a sprint. And there's going to be those little issues along the way, little speed bumps, little hiccups. Maybe the system doesn't perform as you had hoped, or it takes longer for the staff to adapt. That's where that training is key. Just keep tweaking, keep adjusting, and that's why our people we pride ourselves on being adaptable. And I think that's one of the most important skill sets that we can have, kind of looking to the future and having like an optimistic outlook, is having an adaptable team. And I think that's probably the most important thing.
Yeah, I love that bit about having an adaptable team. And then if you have that, that's great, because that's one of the most challenging aspects, because to handle and to implement. So great to hear on that. So thanks for that. Love to talk a little bit more about sort of your partnerships with Acuity, and sort of what the business or what the proposition really has been able to contribute to your strategic priorities and drive ROI. So Doug, I know you touched upon that a little bit. Love to get some more thoughts there.
For sure, definitely. Moving from the kind of I call them legacy systems, right, into the newer tech. That's been a big focus of us, especially since commercial lending in general is not only relatively new and young to our credit union, but credit unions in general. It's a space that we really didn't occupy before. But kind of bouncing some conversation off of Paul whenever we were initially talking our introductions, like there is definitely a space for that. Community banks and credit unions, to be competitive, and we're all trying to really kind of do the same thing, right? Take care of our borrowers, take care of our members, right? So we've been moving away from some of the clunky, outdated software, and it used to be the industry standard, and now we're embracing more agile, cloud-based solutions. The new systems are not about necessarily just being new, but they're more about integrating and being data-driven. It helps us make kind of faster, more accurate decisions. And it's not all smooth sailing, right? But one of the headwinds we face is resistance to change. That's human nature, especially when folks have been using a system for amount of years, even decades, especially even whenever things are reported a particular way. But there's also a challenge of data migration, which can be a massive headache. But ensuring that valuable data is transferred accurately and securely, especially with kind of leaning on the tech side, that's been a great thing. That's where communication and training are really key. Make sure everyone's kind of on the why behind the change. I'm always a big advocate of that, the why more so than the how. And that way, like I mentioned before, the training sessions are very important. We have a great relationship with yourself and Acuity, where we're growing together, we're developing together, we're leaning on each other, and there's a relationship for a reason for us to kind of be able to grow and kind of see the fruits of the labor over time repay themselves. So that's been a big thing for us. Being patient and overall, the journey to update our systems has been challenges, but there's a massive amount of benefits. I can speak a lot about the positives that come from doing things like that and having those types of relationships. So, the better data insights, the improved efficiency, which helps us for enhanced scalability, and that's where it's absolutely worthwhile. So I agree.
Thanks for that, Doug. Appreciate it. Ken, would you like to share your view?
Yeah, on the technology front, we do like to be able to stay somewhat modern in our technology stack. Every major project, every project has a business case where you have to be able to justify an ROI. I would say some of the challenges there come with when the project is more subjective, where you have to do it to modernize your platform, where you have to do it to retain your clients. Those business cases are a little bit harder to articulate. There may not necessarily be an ROI with those projects. So we have to go the extra mile to kind of sell those and justify those. Along those lines, the other headwinds that we've seen is just kind of the drying up of the technology budget over the last couple of years. It's been a little bit more challenging to get some of your discretionary projects through the process, but we are optimistic that moving into 25 and 26, we'll be able to see a little bit more of our budget allocated to discretionary projects that really allow us to differentiate us between our peers. So that's kind of what we're seeing on our side.
Got it. Thanks for that. Paul?
Yeah, Ken stole some of my thunder. I would say that I think the biggest challenge always for us is the budget. I think being able to prioritize kind of what we can and cannot implement. You always have to prioritize those things. And again, we're, as I'm sure others are, we're having to compete with those kind of across the entire firm. So it's not just PNC real estate; it's really PNC as a whole. So how we fit in, what we're doing, all those things are all competing forces. So where I think Acuity and other partners really help us is. And I like Ken's term, being a fast follower. I think we're probably in a similar category where we want to, get the knowledge from you guys in terms of what are the best practices that are out there, and find ways to implement those inside PNC. So we want to be able to implement them quickly, obviously. But I think being able to know what technologies are out there, who's using it, how it's being used, and then being able to sort of fit that into what we're doing really helps us really kind of modernize our technology inside real estate.
Got it. Thanks for that. I appreciate the call again. Hey, Rajeev, would you like to weigh in?
Yeah. So I would say that how the banks treat IRA to Acuity is primarily based on our experience, because we have 20 plus clients and the experienced personnel whom we hire, like people like me also, we are platform agnostic. At the same time, people also leverage equity, or lenders leverage equity for the bespoke technology as well, which we create in-house through Beat to integrate their portfolio dashboards, be it their covenant tracking, or be it AI, LLM driven, some kind of automation towards the extraction process or language driven for a writing process. At the same time, things like portfolio monitoring, Equity can provide a standardized approach, a better risk monitoring approach where 100% of the monitoring is done on time. So that situation like this year where banks have to regulate and monitor the portfolio risk is maintained on time. At the same time, as part of the strategic priorities shift, if banks would like to leverage all of a sudden jump in volume or starts, Equity can easily facilitate those staffing levels within few weeks so that banks are not be far behind in terms of satisfying the regulatory requirements. So I do put that there.
Thank you very much. Thank you very much. And I know we've come up to our some of the themes that we wanted to cover, and we now have a bunch of questions from the audience, and the particular one stands out and is a very good segue into the technology conversation we were just having. So the question is, how do you align and sort of decide on build versus buy partner decisions within technology? We can kick off with Paul.
Yeah, so I mean that's obviously a question that's really difficult for us to kind of always go through. We have a technology called Enterprise, which is sort of industry standard in terms of managing real estate portfolios. So we put a lot of time and money into that technology, but we build around it. So I think that for the things that we know we do very well, we put the money into. For the things we think that we can get leverage, get help from, which I was kind of referencing before. I think we'd like to again meet with lots of folks like yourselves to get really good ideas and good best practices so we can make that decision of build versus buy. We're not going to be able to build out everything, and there's definitely products and partners that are out there that can do things probably more efficiently than us just trying to build it from scratch. So I would say just it's us being educated and getting educated around kind of what's available and be able to make that analysis as to whether or not it's something that we really sort of have incrementally or something that it's best to sort of just plug into sort of what we use.
Got it. Thanks for that. Ken, Doug, would you like to weigh in?
Yeah, I'll jump in here. We are typically now a buy first or exhaust the buy options first before you build. We are a bank. We are not a software development shop, though we can do that. We can do that in some areas. We focus our build over solutions that will give us either a competitive advantage or we want to provide a unique client experience, such as the way we go to market with our external facing software applications here. But it continues to be the struggle. Every time you look at buy or build, and do you want to take on the risk and the maintenance and the costs of having to actually build something yourself, or do you want to be able to offload that to maybe a strategic partner or a vendor that can take care of that? And that's where we tend to lean.
Thank you. Doug?
Yeah, there are a few pieces that we will do in-house, and a lot of it comes to down to budget. And Paul touched on it, and I think he made a great point of kind of knowing your assets, knowing your skill set, and kind of leaning on that for things that do need to be built. So we do a lot of that for a lot of our internal reporting, ensuring that we're reflecting things correctly. For most other things, because of our size, because of our having the other side of the house and the nature of the business of the credit union, a lot of it's going to be a buy for commercial real estate in general. So because of our sizing, like I mentioned, the ability to turn the ship so quickly, a lot of it is just given our resources, it's a buy, and as long as it makes sense. We have some relationships that we have with some of our core and things like that they're branching out as well that we can kind of get attached to. But there's a lot of pieces that are like kind of having Acuity as our overseas underwriter. That's a big piece. We're building out our credit department, so the supplement having that and their expertise, that's where it really helps kind of turbocharge our efforts to meet our strategic goals. So in that case, it's a buy.
Got it. Thank you. Yeah, and look, if you're buying, you also get the opportunity to work with somebody who has a bit of a worldview, can bring in street practices, and sometimes we are burdened with that decisions ourselves, right? do we build or do we buy particularly software? And I think in our case, I think we've done both. We try to build and then we decide to buy. So that's interesting. Let's talk a little bit. Someone's asked, how do what factors do you consider as you look to partner with a firm like Acuity? What are some of the differentiating aspects? And when you made this decision, what was top of mind for you? Ken?
Yeah, I was part of the evaluation that brought on some of our offshoring partners, and we toured India and talked with these different firms that could provide the service for us. And I'll just list a couple of factors, but it wasn't just price, right? It was culture and it was service, and that's really what was the driving factor here. I mean, I could say a couple things about Acuity as far as their ability to service the needs that we have and be really flexible to mobilize teams to address some urgent projects that we have. But it's really focusing on that alignment of culture, priorities, and customer service that we've looked at as a priority. But you also have to make it work from an economic standpoint as well. So those are some of the factors that we've looked at historically.
Thanks for that. Paul?
Yeah, I would echo some of the things that Ken said. I think culturally is really important for us in terms of how our two firms work together. So I think that's first and foremost, very meaningful. And, we've been very impressed by, by all the folks that we've met at Acuity. So I think it kind of goes from top to bottom in terms of sort of who's working with our stuff and our portfolio, as well as who we've met in leadership kind of across the board. So it's not any one person, it's really kind of everybody, kind of how we fit kind of between the two firms. And I would say maybe adding on is that, the way that we look at it is it's not any one given project. Yes, there's something you're working for us right now, but it's the ability to be able to scale up this into other projects for us that we feel like we can do with Acuity. So the fact that you can sort of solve our immediate needs, but we can sort of grow into other projects, other things that we think are important to us, is definitely part of the decision-making process for us.
Got it. Thank you so much. Doug, very quickly, I think we have a couple of more questions. Did you want to weigh in on this one?
Yeah, I'll just briefly touch on it. For us, it's communication. There is an 11-hour difference, I believe, Central Standard Time to your time. So even with that, communication's been fantastic. You talk about quick response time, and that's what really we have a lot of value in. Competition here with community banks, we're all kind of offering the same product, right? I mean, yes, we have in some places lower cost of funds than others, but that turnaround time, that personal experience, that culture, and Acuity really mirrored what we have here at Rally, and I think that's why it was the best choice for us.
Got it. Thank you for that. We have a market question. So it was articulated that 24, 25 is going to be uptrending for in terms of volumes. And as there's growth in the market, obviously everything turns positive. But what are some of the avoidable pitfalls, or from your experience, and if you were to share with yourselves 5 years ago, or with other lenders in this industry, what are some of the common pitfalls to avoid as this market expansion of your business? Paul?
Yeah, let's see if you want to jump in. Yeah, so I would say that for us it's always about sponsors. So again, I would say that I think this is for any given credit union or bank. I think who we do business with is the most important thing that we do. So I think that we are taking the time, while we're not extremely active, to make sure we get to know those folks that we're sort of bringing in new to the portfolio. So it's, to me, that's sort of kind of the basics, the blocking and tackling of banking, but being very careful sort of who you're doing business with, being mindful of how you're doing it, and making sure that the sort of lending that we're doing is in not just lending, but also the other products and services that the bank offers is really a good fit with the companies that we're sort of doing business with. I mean, anymore, it's not really about just making a loan for any of our institutions. It's really about bringing a bigger relationship to the whatever company it might be. So making sure that whatever we're doing is really something that is of use to the company that we're doing business with.
That's a great point. Thank you. Doug?
Yeah, I mean, Paul really summed it up very well. kind of going back to the basics regarding relationships. It's one thing to mitigate risk, and it's another thing to kind of put a borrower in a tough position. You don't want to kind of put someone between a rock and a hard place by making something that's potentially unattainable. You want to make sure that it's a relationship that works together. And there are such things as kind of being overly cautious to the point that this borrower doesn't have the ability to move. They don't have the ability to grow, and you're kind of stifling that. So I think to Paul's point, structure's a big thing. Not only on the loan side, but the relationship side, the deposit side, and ensuring that the relationship's mutually beneficial. I think that's probably the most important thing.
Got it. Ken?
Yeah, the only thing to add, and I would echo everything that Paul and Doug had mentioned here, is just as we watch the economy turn, as we watch the spigot open for lending, pricing is going to get competitive. A new administration is going to want to spend some money. How will that impact a potential resurgence of inflation that could impact the Fed? So not that we can avoid that, but we can watch and see it coming. So we need to be really attuned to kind of how the economy starts to turn, and can we continue to make this soft landing?
Thank you for that. I know we are up on time, but I have one more question, maybe possibly two, particularly as it segues into what you just mentioned, Ken, about the new administration. With the new administration, the politics of it aside, what are we expecting in terms of deregulation and impact on growth, specifically for banking and again within commercial real estate? Ken?
Yeah, I think a lot of people are bullish, right? With a business-friendly administration, less regulations, more M&A. We'll just kind of need to see kind of how that evolves and how quickly we get out of the gates to see if it's done in a smart manner. So a lot of optimism out there.
Paul?
Yeah, I would say that I would agree with Ken there. And I think that what's going to probably happen with the market's probably seeing is just maybe an acceleration of things that were sort of in place for commercial real estate. Not really thinking necessarily the banking industry overall, but really in our segment alone. I think that we were on a path of sort of getting to better days for commercial real estate. I do think that there's sort of a belief out there that we'll maybe move to that a little bit faster. But again, I think there's also on the flip side there's fears of reinflating. So we've got to watch sort of both sides of it. But I do think that things might just get a little bit more accelerated down this path we're moving down now.
Got it. So certain things are already in motion, and this could just accelerate a building
I think
trend.
So.
Got it. Doug, your perspective here?
Yes, yeah, definitely. I think the key word is acceleration, right? Whatever was going to happen is probably going to happen sooner, and there's probably going to be. This may have been the catalyst to kind of, you have inflation on one hand, you have kind of the recovery of commercial real estate on the other hand, you have rates, like Ken said, the soft landing is so important. Just because it's such a fragile thing, resilient yet still fragile as far as the economy. But it's still early to tell. There's a lot of optimism based on the stock market and movement and things like that. So hopefully the business side of things continue to go well, and we don't get out the gates too fast. Like Ken mentioned, that it's a steady growth, steady development, and hopefully we just don't have kind of short memories and kind of getting too optimistic, right? We just keep our one foot on the ground. So that's what I would say is probably the best outlook going forward.
Got it. Thank you for that. Last question about competition from private capital. They're growing leaps and bounds. They're competing. Banks are partnering with direct lenders. Mizuho just partnered with Golub. I know PNC has their own partnership as well with TCW. What are your thoughts there? Let's start with Ken.
Yeah, I mean, we're continuing to explore all options of capital sources. In addition to having our own debt fund, with capital sources abroad, we continue to kind of seek capital sources wherever we can, and that's one of the things that we're able to do, is just to acquire a lot of different capital sources to be able to provide the best financing and the best products to our clients' needs.
Is there an element of competition as well from private capital who are lending directly?
Well, I think for us, and it sounds like, both Paul and Doug is, we are in a relationship business. We're not just going to go out and loan a loan for the sake of getting best pricing. We want someone that is going to bank with Key and that we are able to provide a service to them. And if all they want is the best pricing on an individual product, then they're probably not the best fit for us.
Got it. Well said. Paul?
Yeah. I was going to say that, not speaking too broadly, but I think that really our direct competitors are not private capital. I think that they're definitely there's a spot for them in the market. There's definitely folks that are using them. It's good to have that capital kind of coming through, but in our day-to-day sort of portfolio that we run sort of inside real estate, we're not directly competing against private capital. So there's definitely ways that we're exploring in terms of accentuating and partnering with it maybe, but for what we do, it's not really necessarily directly competitive to what we do.
Got it. Doug?
Yeah, I have to echo what Paul was saying. I mean, there's definitely an area for all that sort of lending as far as hard money, private capital, those type of immediate sourcing. But kind of where my specific financial institution's at, we're not in that arena at this point. We're still in kind of the growth and development. The competition's not including them at this point, so they're kind of not really on the radar. And sometimes when the spreads have to be so thin that it gets to the point of maybe not the profitability that we need for usage of funds, or even like our return that we're looking for. Like Ken said, we're more of a relationship financial institution, and I think that's what we pride ourselves in being.
Got it. Brilliant. Thank you so much for this, and thank you so much for the very interesting conversation this morning. I quickly, I think 5 key points stood out for me. 24, 25, particularly going to 26 as well. Certainly uptrending in volumes. Going from playing defense to playing offense, that stood out for me as well. Particularly in multifamily, industrial warehouses, office sort of continues to be another problem child, is what I heard. Enhanced focus on credit quality, stress tests, get ahead of the problem and stay close to your clients. Technology-wise, technology is here to stay. Obviously, not the easiest conversation, not the easiest implementation, but certainly here to stay, and more to do in this space. And then, finally, expect acceleration with the new administration as it relates to expansion of the business, deregulation, and potentially consolidation as well. If there is, from the audience again, if there's any questions, feel free to email us, and we'll try to take those back. This is me up on the left, and with some of my colleagues, Karthik and Johan, who's based in London. Big thank you again to our global audience who joined in, and big thank you to everybody in the background who managed to make this, to help come up with the content and the logistics of it. There's going to be a short survey for yourselves to fill up. Shouldn't take more than 30 seconds. Feel free to reach out if you have questions or would like to get in touch. Once again, big thank you, and have a great day ahead. Bye.
Thank you.
Thanks.